Good morning, everyone. Trust we are doing good. You're welcome to another webinar we've got for everyone. If you can hear me properly, just a quick sound check. Please drop a yes in the chat box if you can hear me properly. And if you can't hear me properly, please drop a no in the chat box. Thank you very much. Okay. So, um, Olusegun, it's quite amazing seeing you on here. Thank you very much. I really appreciate the fact that I called and you were able to find time to attend. Thank you very much. Emmy, also, thank you very much. Ayodeji, hope you're having a great morning. You've been attending my class like consistently. Yeah, thank you very much for that. I appreciate everybody on the call. I appreciate everybody on the call. It means a lot to me, actually. And since we had a few persons join early and they left, so just a quick introduction. I'm your host, Akinwale Chibuike, and I've been your host for quite a while now. I've been your host for quite a while now, and it's actually been I've actually been walking everybody through the financial markets with EGM, and it's been a pleasure doing that. I feel very happy because I've been sharing value, um, dishing out knowledge also, and how to approach the financial markets the right way. And that's been very, very amazing. And there've been a lot of changes in the patterns clients under us trade because they've been applying the knowledge and it's been working quite well. So that's just it. That's just it. So, like I always say, I always do in all my webinars. At EGM, we have the best products that offers you access to the financial markets. We've just got three persons on here except for myself, and I'm trying to like while time away while other people get to join us. Okay, so that's just a major thing. And yeah, um, we've got the best products for everyone to actually access the financial markets and grow their wealth the best of way. We've got the MT4, which is the dollar platform. You can trade the financial markets in dollars, and we've got the cloud trade platform where you could trade the financial markets in Naira. We've also got the copy trade platform where if you're too busy to actually learn about the financial markets, or you just don't have interest in learning about the financial markets and you want to earn from the financial markets, we've got a product for you, which is the copy trade platform. It's a partnership with us and Zulu Trade where you could actually we give you access to thousands of consistently profitable traders, and you get to copy the trades and also be in full charge of whatever they do on your trading account. And that's just it. JK, thank you very much for joining us. Thank you very much. It means a lot to me. Okay, so I just like to show you our trading platform. Just share my screen and show you our trading platform, how it is, how the front face, the face of the platform is. So let me just quickly log into my put that on my screen right now, and yeah, we are good to go. Okay, share my screen. If you can see my screen properly, please do drop a yes in the chat box, and if you can't, please drop a note. Thank you very much. Okay, great. So that's how our interface is. These are our interfaces. Just very easy to navigate and all, and log in. Just log in my account and you get to see how the platform is. You get to see. Okay, let me just refresh that and yeah. So this is how the interface is, and this is the interface right here. This is the profiles, deposit, withdrawal, payment history, and all. That's how it is. And let me share my screen so you could see how the Kelechi. Good morning, good morning. It's amazing having to get you on here. It's amazing. I actually didn't call a lot of persons. I just called 8 persons because setting up the link to the webinar, I didn't fill in the space for numbers, so I couldn't really call a lot of persons. So as you can see, this is the cloud trade platform. This is how it is on the chart. You can see how sleek it is, very easy to navigate. And also you can see I'm on some running trades, UK 100 and gold. I expect gold to get into profits very, very soon. So that's just the platform. And let me just show you charting platform, how the charts looks like. How the charts look like. Like it's very, 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 very simple and interesting actually. Very, very simple. This US 500 charts. I could hide these buttons right here. I just click in that place and just look at the charts. Like yesterday, US 500 has been on a major uptrend. I might be looking for sales soon on it. Just in my own perspective, though, I'll be looking for shorts soon on it. See how sleek the charts look, and the time frames. I could switch between the time frames to the 4 hour if I like, and just get to see how it looks like. Very, very simple and easy to navigate. Also, I could just extend it to another tab on my browser. I could extend it to another tab on my browser, and let me show you that. Extend it to another tab on my browser, and you see how it is to navigate, how easy it is. Like it's on another tab on my browser right now, and I could plot a lot of things on my chart. I could use the drawing tools, whatever it is I want to draw. I could use a lot of tools right here. Like I could draw a trend line if I like. I could adjust my trend line settings also. Could scroll down. There's a lot of tools on the platform. A lot of tools. Decide plotting my trend lines here. Plotting my trend lines here. I could decide I want to draw a box to find support and resistance. There's a lot of tools actually. A lot of tools you could actually familiarize yourself with and use it to earn consistently from the financial markets. We've talked about this tools and this platform multiple times. So it's nothing. It's something everybody's familiar with if you've been attending my classes, and also the dollar platform too. We've been talking about it multiple times. Also, that's just it. And with our platforms, they are easy to navigate, easy to access, easy to use them to make money. Oh, Debbie, it's a pleasure having you on here. Aroma, it's a pleasure, like very, very huge pleasure for me because I didn't call those persons and I just wonder how they would still reach this figure on the call. So, before we proceed to the next class or to what we have today, um, we're talking about, like I said, we're talking about risk management, managing risk, smart traders guide managing risk, like how you manage risks like a pro, how you manage risk like a pro. That's what I'm talking about today. And before we proceed, from our last class, has anybody got any questions at all? From the last class we held, which was copy trading Easter eggs edition. I talked about a few tips and tricks I use when copy trading. Does anybody though have a question? Let's start with that. Or do you have a question about the markets, general market outlook and all? Do you have a question at all? If you do, please let me know so I can hop on to answering them right away. And if you don't, please let me know so we could proceed to what we have on the table today. Okay. So please let me know. Let's do that in 2 to 3 minutes so we can proceed to the next class today. Morning, Julie. Morning. So I'm waiting in case there's a question. I'm waiting. I want to know if there's a question so we could actually get right into it. Okay, I'm expecting the questions. I'm expecting a lot of questions actually. So let's do what to ask questions. Okay. Great. Okay, so what questions do we have? None. Okay, we've got one. When it comes to indices, like these are economical factors concerning a country. Like when you understand how the country is structured, how the because DE30 is actually a German index, and Germany are producers, they export, they do less of importing. You should understand that they have a long term of being bullish. They have a long term of being and at the moment I wouldn't be hopping into that bullish trend because it's not showing me any sign of correction or reversal. So what do? I just only anticipate long positions when I get the opportunity to. Okay. Kelechi are weekly on that. And also, Silas, I said this multiple times, there is nothing termed as the best in the financial market. It is figuring out what works for you and how to apply it. It's figuring out what works for you and how to apply it. That's the major thing. Okay. That's the major thing. It's understanding how this thing works and how it can work for you consistently. Okay, that's the major thing when it comes to the market. There's no best. There's no best. No, it's understanding. Okay, does the 200 moving average work for me? The 50 moving average. Does the 50 moving average works for me? That's the major thing. That's the major thing about the market. Now, when the market is down for a certain period of time, how do I know the copy trader to follow? I can only decide the copy trader to follow when I understand how the copy trader works. Or how the trader works? How do I understand? I read the strategy, I go through his previous history. Okay, I go through his previous history, I read his strategy, and that's the major thing. Understand how to understand the trader strategy on the platform. Then what next? You understand his previous history. How has he been doing in the downtime of the financial market? How long does his downtime occur? Those are the things you need to take note of, and that's what the financial market is really all about. Okay, good morning, Theophilus. Trust you're doing good. So Theophilus, you said your profits. Do you mind explaining about the profits aspect? Because I am going through my data right now, and you laid a complaint of loading your profits or something like that. Do you mind going further into it? Thank you. So I could actually walk you through it, and we move to what we have on deck. Okay, I shouldn't worry. I should just go ahead. Okay, thank you very much. So, the thing is understanding how the market works. I said something during as a closing of one of my classes, and I would say it again. I will still say something else at the closing of my class, but I want you to understand that the financial market is forever evolving. Okay, like the financial market will always change its patterns, change its way, and all. And I'll term that as something very very dynamic when it comes to the market. And when you understand that the financial market is dynamic, you should be dynamic also. You should be like water. You should learn to attain the shape of whatever it is the financial market is doing. If the financial market is bullish, try as much as possible to be bullish. If the financial market is bearish, try as much as possible to be bearish. Stop looking for reversals. Rather, follow the trend. The trend is your friend when it comes to the financial market. So when you understand that the financial market is very, very, very dynamic, you have to be dynamic with the financial market also. Learn to take the shape of the financial market. Like I said, if it's bullish, be bullish. If it's bearish, be bearish. If it's consolidating, learn to either be consolidating or take a break. That's just the major thing. So I hope we are all clear on that. And let's drive right into what we have today. So I said it today. There'll be more of talking, more of doing, less of drawing things on the chart. Okay, more of talking, more of using the whiteboard, and less of doing things on the chart. So I want everybody to get a pen and paper because I'll be dishing out massive value, massive value. If you don't get a sheet of paper, just do ensure that you actually are going to go through this webinar again. Like you are going to go over the webinar again. Okay, you're going to go over the webinar again. We're going to go over the webinar again. If you don't have a pen and a paper with you, just know you'd go over the webinar again, and that's the thing. Like that's the major thing. Because what I'll be dishing out right now, it's like value in general, value, like massive value. Okay, so yeah, Hope. Good morning. Trust you're doing good. So let's start off with what we have today. We're talking about risk management. Okay, risk management, risk management. Now, from the word risk management, I want to get almost everybody's opinion. I know some people on this call, they don't like talking, they don't like engaging in the chat box, but risk management, what do you think risk management is to you? Just give me your response in the chat box. I'd love to get a response in the chat box. So, what do you think risk management is? Just your own personal thoughts, your own personal preference, what you think risk management is, okay? Okay. So what do you think risk management is? What do you think risk management is? What do you think risk management is? I'd love to get responses in the chat box. Like I want to know your idea or your thoughts when it comes to your tolerance level before getting out of a trade, an act of limiting extreme losses, controlling losses. I'd love to get more though. I'd love to get more, like more. Okay, more reasons. What you think risk management? Because there is no. I always say this. Nobody is wrong. Nobody's right. It's all hypothetical. Okay, it's all rhetorical. Let's put it that way. All rhetorical. So, like I said, it's all rhetorical. Nobody is wrong. Nobody is right. So, Kilishi says risk management is the amount of capital you emotional balance to accommodate on any trade, getting out of trade when you've gotten your plan, profit or strategic management of financial losses. Risk management is the pattern or strategy to control or reduce. Everybody is right. Like everybody's saying something that relates to risk management. Okay, everybody's saying something that relates to risk management. But the major thing I want you to understand is risk management is not just even about managing your losses. It's not about positioning your size properly. It's not even all about, or it's not even about majorly about it's not majorly about how would I put it? It's not majorly about maximizing your trades. Yes, it's not even majorly about like risk management is very broad, and everything I'll be teaching you is just a touch of everything, a touch of everything. So there's this law, or there's this fact about the Chinese dynasty that in the Chinese dynasty, the emperor can't eat all the food on the table. Okay, he's not permitted to eat one type of food on the table. He has to take out of all of those food, like a spoon out of all of those food, and that's what we'll be doing on this webinar. Risk management is very broad, or very broad, that I can't even talk about it in detail. I just have to like go over each and every one, dedicate a few minutes to each and every one. So let's get our pen and paper ready because we're about to move. Okay, so this everything I'll be saying here is based on my preference as a trader, and also general preference as traders, as people do. Okay, my preference as trader and general preferences as trader. Now, general remarks on risk management. General remarks on risk management. Okay, general remarks on risk management. Risk management is the most important topic when it comes to the financial market, but it is the least popular topic when it comes to the financial markets. What I mean by that is this topic is very important that we don't know that it's important. We are only concerned as traders, we are only concerned about a working strategy. If you have a working strategy, hmm, and you don't have the right risk management plan, you don't have the right risk management plan, that strategy won't work. That's just like it's the common rule when it comes to the financial markets. I don't want to know how that strategy works well from whoever you bought it from or whoever taught you how to use it. If you don't have a very, very good risk management approach, risk management plan, it will never work for you. Because when you don't know how to manage risk, you end up using the strategy the wrong way. Are we clear on that? Are we clear on that? This webinar will not cover all of risk management, but will cover the most basic things about risk management. There is nothing fancy. You do know me quite well. I won't do anything fancy on the webinar. It's just straight to the point. Like most of my webinars, nothing fancy. I just go straight to the point. And that's what I'll be doing here. Now, the webinar is generally created to create clarity at its peak, like clarity at its peak when it comes to risk management to everybody on this call, whether you are a newbie or you are an intermediary when it comes to trading, or you are a professional, or a profitable trader. Pro can stand for professional or profitable trader when it comes to financial markets. Some traders are professional and they are not profitable, while some are profitable and they are not professional. Determine your pro yourself. Okay. So the next thing is there are a lot of variables. Like I said, there are a lot of things that consist of risk management, and we can't eat everything. We just need to touch everything, and everybody on this call would have to go and do their own in-depth findings. Good risk management comes with good journaling. If you can't journal your trades the right way, and if you can't determine things yourself based on personal preference, you can't even attain a very, very good risk management approach. How much are you willing to risk per trade? When is it to risk an unusual amount? When is it not to risk an unusual amount? Is the risk to reward ratio low or high? These are the things that entail when it comes to risk management. Like these are the things that risk management entails. And lastly, the simple truth I will tell you, I always tell everybody the truth. The simple truth I will tell you is no matter how fancy your technical analysis are, no matter how many lines are on your chart, no matter how the confluences on your chart are telling you to buy or sell, no matter how accurate your technical analysis is, there's no point in it at all if you get wiped out of trading. If you get your trading account wiped out, there's no point in it at all, no matter how accurate. Because if it's very accurate, you should be profitable. You should be consistently profitable. And there's no point at all if you continue getting stopped out of your trade because of you're not managing risk the right way. The goal is to manage risk the right way, earn profit consistently, and stay in the game for long. The game is the financial markets. Are we all clear on that? If we are, please drop a yes in the chat box. And if you're not still clear on it, please drop a no in the chat box. I'd love to get more responses. I'd love to get more responses to know if everybody's following me. Okay, great. So just a quick one before we continue. If this is your first time on my webinar, please just drop a hi in the chat box so I can take note of you and reach out to you. Okay. If this is your first time on my webinar, please drop a hi in the chat box so I can take note and reach out to you after the webinar. Okay, Emma, it's a pleasure. It's a pleasure. If this is your first time on my webinar, please do drop a hi in the chat box. And Kasim, it's no problem at all. Thank you for joining. If this is your first time joining my webinar, please drop a hi in the chat box, and I'll reach out to you after the webinar. Okay, just drop a hi in the chat box. Thank you, because I'm seeing a few names I haven't seen on my webinar in the people section, and I'd love to reach out to you after the webinar to get to know you more. So please, if this is your first time on my webinar, just drop a hi in the chat box. No, you haven't missed a lot, cousin. You haven't missed anything at all. Okay. So Emma is the only new person there, so thank you very much. So we're done with general remarks on risk management. I told everybody the facts and truth. You won't get outside, like you won't get it even on a paid webinar. I told you guys the simple truth and all. So let's move to risk management itself, the concept of risk management itself. Now, everybody gives the definition of risk management, and it's all relatively the same. Like from what I read, everybody's trying to make a point. Okay, everybody's trying to make a point, and all points are literally the same. So, what really is risk management? Just take it as a simple approach that comprises of action an individual or trader uses to protect the downside of every trade they take. Just take it simply as that. Risk management is an action you take. Not just one action. I said actions. Okay, it just comprises of actions you as a trader take to protect the downside of every trade you place. Every single order you open, it comprises of actions that you as a trader take to protect your account from every trade you take. Now, why are you protecting your account from every trade you take? The major thing is not to lose money. Not to lose money. Because we do know how the financial market is. We do know it's full of probabilities and possibilities also. And we are trying as much as possible to be on the right track and to be safe every single time. So we apply risk management. We manage our risk. We try as much as possible to manage our risk on every single trade. Do we understand that? Do we understand that? Are we clear on that? Am I making sense? Please do drop a yes in the chat box or a no in the chat box. Okay, great. Now, simply put it as more risk means a higher chance of sizable returns. All of us likes to take risks. Like we all love to take risks because if we take risk, there's a tendency that we'll make more money. But all greater chance of significant loss are also there. Like no matter how much you risk, no matter how well the analysis is, no matter how well the analysis is, if the trade is to go against you, it will go against you because you can't fully ascertain what the markets will be. So more risk you take means you make a lot of money, but there is a greater chance of significance that if a loss happens, the trade will fall apart. And that's the financial market for you. So taking risk is good, but taking calculated risk is better. Okay, you need to take calculated risk, not just risk. You need to take calculated risk because calculated risk, you have a chance of not losing all your money. You have a chance of not losing all your capital. You have a chance of coming back to the market again and making a good turn or a good trade because you've risked less and you have more to come back with. Now, there's this general saying or this thing people mix up. There's this thing people mix up, and it is money management. Risk management is never the same as money management. Please don't mix it up. Don't ever mix it up because risk management is not the same as money management. Risk management is different from money management, and you need to understand the difference between these two. Risk, you are managing your risk when it comes to risk management. Money management, you are managing the amount you're putting in the trade. You're managing the process of how you position your size in the financial markets. And there's one thing you need to learn, which is how to manage risk the right way. You have $100 account, you shouldn't be using one standard lot. You have a $200 account, you shouldn't be using one standard lot. What should you be using? I'll let you decide that yourself. But A calculated risk on that literally means you should be aiming to use a lesser lot size so as to be on the top side every single time you enter into the financial markets to place a trade. Are we all clear on that? Are we all clear on that? Now, there's this popular saying. I just remember the popular saying. It's from Trading for a Living by Dr. Alexander Elder. He wrote a book. They call it Trading for a Living. Okay, Trading for a Living. I'm not really sure, but I just know it's Trading for a Living or something. He wrote a book, and there's this common quote in that book. You see, the goal of a successful trader is to make the best trades the right way. Okay, the goal of a successful trader, if you want to be a successful trader, your goal is to make the best trades the right way. The right way includes managing your risk the right way. And when you make the best trades, what comes in next? Money. So money is always secondary. Money is never primary. Okay, money is always secondary. What is primary is making the best trades and managing your risk every single time. That's the best quote that actually goes in line with the concept of risk management. Now, what risk management entails? Risk management entails a lot of things, but I think these are the major things. These are the major things, and that's what I'll be talking about. The major things, that's what I'll be talking about. Okay. Now, the first thing is stop losses. The second thing is the risk you're taking per trade and also position sizing. How do you position yourself? How do you size your position when you get into trade in the financial markets? Profit maximization, how you could evolve your trades. Now, I know somebody might have heard of evolving trades before, but this is something different from the evolving trades you've heard of. And the next is handling drawdowns. How do you handle a drawdown? Do you squeamish out of it? Did you scream and get all angry? And is that how you handle your drawdown? Or do you start praying to God whenever your trade is in a loss? You start praying for direction to change. How do you handle your drawdown? And the last thing is using margin the right way, using leverage that will give you the right way. And we'll start with stop losses. We had a class previously on stop losses, how to apply stop losses, how to calculate stop losses. But I want you to be very, very candid with yourself. Very, very candid with yourself. When last did you use stop loss on a trade? I'd like to get your response on the chat box. When last did you use a stop loss on your trade? When last did you use a stop loss on your trade? Just give me a response in the chat box, okay? I'm trying to figure out something. Be candid with yourself. Don't be candid with me, but be candid with yourself. Your answer, be candid with yourself. When last did you use a stop loss on your trade? Since 2019, yeah, this morning, okay? Not often. Someone said not often. Last week. Someone said last week. Wow. Not often. Last week, not often. I don't use it often. 3 weeks ago. Okay. I knew I would get this type of responses. That's why I wanted to get this type of responses. Okay. Because I'm glad everybody's being candid. I'm glad everybody's being candid. And I'll be talking about stop loss, just not in detail, but quite in detail. Someone said he only uses stop loss when the market is on the bullish trend. Wow. I'm laughing right now. But it's all good. It's all good because everybody's being plain, saying the truth, and they try as much as possible to be honest. And I love that. And let's go to stop losses. Okay. First is, what is a stop loss? Just simply put it as a stop loss is an order. You're telling me as your broker to close your trade or your position at a certain price point or percentage to limit your losses. That's what you're telling me. That's simply what you're telling me. That's what is stop losses. You're telling me as a broker, sir, close my trade when it is against me by $10. When it goes against you by $10, I will close your trade for you. That's all stop loss means. That's what stop loss means. And I'll be candid with you. I personally always don't use stop losses, and I don't implore everyone to do it. Like, I personally don't use stop losses. Why? Like, not regularly. I use stop losses, but not regularly. Okay, why? The question is why. It's not because of I'm a professional, and not because of I'm profitable, but because of there's something called psychological levels in the market. It's another story for another day. But psychological level is based on your mind. When you just look at the charts, you know, okay, this is where price will get to for me to close my trade. So that's what I do mostly. So the fact that I don't set my stop loss, I use psychological levels to set my stop loss in my mind. So I just check my charts every 4 hours or so, or when I notice there's something fishy in the market, I just check my charts and all. And when I see it's almost approaching my psychological level, or it's almost getting to my psychological level, I either close my trades or just place a stop loss. Then that, okay, this is where I want the stop loss to be, and if it gets there, no problem at all. And if it doesn't, I move on to the next trade. But to be candid, please always use a stop loss, and I'm begging everyone to always use a stop loss. Not because of you understand how the markets work, not because you're trading BTMM, not because of you're trading ICT, inner cycle traders method, not because of you're trading technical analysis, not because of you're trading indicators, but because of you shouldn't lose all your money on a trade. Because of you shouldn't lose all your money on a trade. That is why you should use stop losses. And that's the major thing. Now, the primary purpose of a stop loss is to protect a trader's account balance when they are wrong on a trade. Like I said, it's protecting you not to lose all your capital. That's the primary purpose, and you should employ it every single time you place a trade. Okay, let me show you something real quick. I promised myself we won't be checking the charts, but we need to check the charts. Let me show everybody something. So I'm currently in a trade right now, and the trade is gold. Now, I went short on gold for a few reasons. I wouldn't be talking about the reasons, but I went short on gold and I placed the stop loss on my charting platform. Now, let's come to my trading account. My trading account. Let me show you my trading account. Okay. I think I have it right here. Okay, that's it. On my trading account, there is no stop loss, no take profit. But I did place a stop loss and take profit here, but I didn't put it on my trading account. Why is that? I simply did that because of I know that okay, there's one account that it would hit on, and when it hits there, I just know I need to just rush down here and close it. So it's literally the same as not putting a stop loss. You're not using a stop loss. Forget the fact that there's one account that has a stop loss and one doesn't have a stop. It's still you don't have a stop loss, because what if price impulses against you and the loss is very, very big? So I implore everyone to always use a stop loss so as to protect themselves and their trading account whenever they are wrong on a trade. So whenever you use a stop loss, what does it do? It just limits your loss. Like, it limits your loss. Instead of taking a loss of $100, you just take a loss of $10. It limits your loss if you are wrong as a trader, and it enables you to continue trading the financial market and be profitable without having to win every time. That's the major thing of a stop loss. So you will be profitable without having to win every time. Like, every single time you'll be profitable without having to win because of your managing your risk using stop loss. That's the same thing, Christian. Remember, I already know the psychological level. I already know the psychological level. So instead of placing that stop loss, I just decide, okay, I know the psychological level, and I feel very, very big. Like, the financial market is something I could just wave and not use a stop loss. I hope you get what I'm saying. So most times you just come to us as the fact that we know our stuffs in the financial market and we feel we're bigger than the market. It should go our direction. Our accuracy rate is good. So not using the stop loss on this is not really big. I've lost money before, so I could risk losing this again. That kind of thing. That kind of thing is what really makes us not want to put the stop loss, even though we know our stop loss value. Christian, I hope you understand. We would even take note of the market is to be liquid. There could be a price pump, there could be a dump, there could be this, but the urge to put that stop loss there is not really in us. But we know we have a stop loss. I hope you understand. I can see Philip is typing something in. That's just the thing. That's just the thing. Now, there's two simple principles of placing your stop loss. There's two simple principles of placing your stop loss. The first principle is your stop loss must be placed based on your technical analysis. After all your drawings and designs on your chart, I like to call it designs mostly because I just like the fun of it, the fun aspect. The financial market shouldn't be difficult. It's very, very easy. So try as much as possible to mix fun into it, although you still have to treat it like a business. Now, your stop loss should be based on your technical analysis. So let me share my screen also. I tried as much as possible for us not to check the charts, but we're checking the charts, so it's not really bad. So after my technical analysis, this is clean lows, this is liquidity right here, this is a bearish order block right here. Price came into it and we went all the way down. What I'm expecting actually is price should come down here. So why did I place my stop loss above the order block? Why? It's technical analysis. I don't expect price to trade into or above the order block. That was why my stop loss is just a few pips above the order block. Simple as it is. So your stop loss should be based on your technical analysis. This is my technical analysis right here, and that is why my stop loss is above the order block. Simple as that. Now, the second thing on my notes here is your stop loss should always be placed at invalidation level. What is an invalidation level? An invalidation level is the point at which your idea of entering a trade has to be invalidated or disapproved by the financial markets. That's what it means. It means that the reason you entered the trade must be disapproved whenever price gets there. So let me show you an example. That's what an invalidation level is. So let me show you an example. Okay. So let me share CAD GPY. I had a trade last week on CAD GPY. Okay, so now I sold CAD GPY, I bought again, and it hit take profit. Now let me explain to you invalidation levels. Okay, let's go to the 1 hour. Now, why is my stop loss above this high here for the sell? It was because of if price traded above this high, it was an invalidation level. I was looking for a sell. At this order block right here. Sorry, at this source right here. And I knew, okay, if I placed a limit order here, what I'm expecting is a sell limit order. I placed the sell limit order and it got activated to sell down into this area. If my sell limit order has been activated and it never sold down to this level and just kept on going up, my invalidation level was above this previous high. Because I believe if price trades above that previous high, that is a higher high. We talked about concept of higher highs and lower lows based on market direction previously, and price creating a higher high just tells me that there is no need for price to be going back to what the downside because of it's an uptrend and there's a higher high. That's just the meaning of invalidation levels. Then what happened? It sold, and I said what? I placed a buy limit order right here. My thought was, if price should trade below this low, which that is where my stop loss is, it should close my trade for me. That's an invalidation level. Because what if price trades below this low, it has broken market structure, and I will be looking for selling opportunities. That will be a lower low. And what happened? Price just hits this 4-hour order block right here, and we reversed and pushed to the upside. We went to the upside, filled this fair value gap here. We pushed to the downside. I was looking for a buying opportunity here, but I slept off, and I got my buy opportunity right here. I just saw the block right here. I didn't even mark out the order block. I just got a buy opportunity and it ran straight to take profit. So I had two buy positions running on CAD And that's just like the concept of stop loss placement. Very simple and straight to the point. Now, let me share my screen. Let's get back to what we were discussing. And okay, so that's it on stop loss placement. And those are the two key principles on how your stop loss should be placed. Now, when entering a trade, you must have a reason for entering a trade. I've seen traders just say, because of my friend is buying CAD I will buy CAD. Because of my friend is selling CAD I'll sell CAD Or they say because of um I'm selling gold, they will just go and sell gold on their trading account. If you trade like that, or you've been trading like that, you'd end up losing money. Why? Because you don't have a reason for entering the trade. The only reason you had was because of your friend was in that trade or your neighbor was in that trade. You never had a reason, your own reason to enter the trade. You just had the reason based off someone's reason. That's, you don't even know the person's reason. And when you take trades that way, you won't even know where your stop loss should be. Like, you won't know where your stop loss should be. That is why you should always have a reason for placing a trade, for opening any trade. Whenever you're trading, you should always have a reason, a good reason for placing a trade, because that reason is what gives you the concept of where your stop loss should be. Now, everything I've said on the stop loss is unique, and it should depend on your preference as a person and also your preference on trade setups. If you're somebody that likes to trade breakouts, the way you set your stop loss will be different from somebody that likes to trade reversals or corrections. So, like I said, everything about the market is based on preference, and you should be the one to determine how you want to approach the markets. Now, are we all clear on what stop losses are? How do we use stop losses when it comes to risk management? How should you apply stop losses when it comes to risk management? Yes or no? So I just dropped a poll in the chat box. I just dropped a poll in the chat box. Please let's respond to it. Thank you. I'd love for everybody to respond to it. Thank you very much. Okay, so risk per trade and position sizing. 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 Now, risk per trade. From the word risk per trade, you should understand that it's just the risk you are willing to to take on a trade. Like the risk you're willing to take on a trade. The risk you're willing to take on a trade. That's just what it is. Now, definition of risk per trade is just what percentage of your total equity you stand to lose per trade. The percentage of, so if you have $100, what percent of that $100 are you willing to risk per trade? That's what risk per trade is all about. That's what risk per trade is all about. Now, what position sizing means? The lot size you use. Let's put it that way. Yes, that makes it more easy. The lot size you wish to use. If you have $100 account, do you wish to use one standard lot, that's 1.00 or 0.10 or 0.01? Is that what you wish to use? That's just the simple approach towards risk per trade and position sizing. But let's go detail into it. Now, risk per trade. Risk per trade. This is based solely on preference, okay? This is based solely on preference. Okay, Philip said he doesn't understand. Let me take it from the top again. Risk per trade, I said, is the percentage of your total equity you're willing to risk on one trade. If you have $100 account, how much are you willing to risk per trade? That's just what it means. So if you're willing to risk 2% of your trade of your $100, that would be $2 per trade. That means you're willing to risk $2 per trade. Do you understand now, Philip? It's all, like I said, it's all based on preference. You could be willing to risk 50% per trade. You could be willing to risk 100% per trade. It's all based on preference. But I majorly advise 1 to 2% per trade. 1 to 2% per trade. That's what I majorly advise. Now, like I said, risk per trade is solely based on preference. Okay, risk per trade is solely based on preference. But to be candid, from majority of traders I've met, majority of traders, their mindset is always to comfortably risk 1 to 5% of their equity per trade. Okay, 1 to 5% of their equity per trade. That is what majority of traders have met. That is what they are always willing to risk. But to me, I prefer using 1 to 2 or 1 to 3. I rather risk 1 to 2% or 1 to 3% per trade. And that is what I believe is appropriate. Going to 5% or 4% is very, very not of this realm. Let me just put it that way. And when you're risking per trade, you don't need to actually reduce your lot size. If you want to take risk, you don't necessarily need to reduce your lot size, but it's best advised to reduce your lot size, because if you don't reduce your lot size, the trade might exceed your risk limit. That means if you open a trade on one standard, if it goes into loss, just know it's not going into a $1 loss, but a $10 loss per pip. So it's always best to reduce your risk per trade. Now, let's say you want to risk $300 per trade. That's 3%. If you have a $10,000 trading account, okay, that's 3%. All you just do is what? 3% multiplied by $10,000. That's how you know the amount you're willing to risk. So if I have a $50,000 account and I'm willing to risk 1% of that $50,000. Exactly, Kelechi, exactly. Knowing your margin. Not in most cases. You see, there's something I've seen going on. These guys say they have somebody that could offer them they say they have somebody that could offer them 25% per month, this per month when it comes to the financial. And I still see people fall gullible for that. Like, to be very candid, if you're trading with your personal funds, it's even difficult to attain 10% per month if you're trading the right way. You're not trading in an aggressive manner. If you're trading conservatively, it's even like quite difficult to attain 10% per month. 10% per month. It's very, very difficult to attain. And I see someone on there promising you 25%, and you end up putting your money, and in the end, they say there's a loss, they can't pay you back. Why don't you just sit back, relax, use a copy trader, or sit back, relax, learn how to trade the financial market yourself and make that 25% yourself? I hope I'm making sense. So not all percentage that glitters is gold. Okay, let's just put it that way. But you need to understand that no matter how well you know how to trade the financial markets, losses are inevitable. And back to what I was saying, if I had a $50,000 account and I want to risk 1% per trade, that would just be $500 per trade. Now, so I'll be willing to risk $500 per trade if I had a $50,000 account. And risking 1% per trade, which is $500, doesn't mean I am trading one standard lot. I could trade a mini lot and still risk $500 per trade. I could trade a micro lot and still risk $500 dollars per trade. So it doesn't necessarily mean you have to increase your lot size. You could use you could continue using the normal lot size you're using rather than increasing your lot size, all because of you're trying to align yourself with the amount of risk with the amount of money you want to risk. And also, when I say you're risking $300, it means if you are getting stopped out on that trade, the loss you'll be getting stopped out on must not exceed $300. It could be below, but must not exceed $300. And there's this popular saying from Warren Buffett. There's this popular saying from Warren Buffett. I'll tell you how to become rich. Close all doors. Beware when others are greedy, and be greedy when others are afraid. Beware when others are greedy, and be greedy when others are afraid. Warren Buffett actually has this mind-blowing quotes, and I still get I still find it quite surprising how he built his wealth just trading the stocks market. And is somebody you should actually look up to if you want to manage risk the right way, because he knows how to manage risk. You should do well to read a few of his books, and you understand how to manage your risk the right way when trading. So are we clear on everything that has been said? Do you understand? Are we clear on everything that has been said? Do we all understand? I'd like to get responses in the chat box. Okay, great. More persons, please. And also, let me clear the air on this. You can't learn trading psychology from a book. You can't learn risk management from a book. You can't learn the right strategy from a book. You can only learn all of these things when you get into the financial market. And when you get into the financial market, I'm not saying you trade a demo account. You have to trade a live account to be able to get all of these things right. Okay? You have to trade a live account to be able to get. You can't learn these things from a book. It's not possible. You can't just, someone can just keep telling you to risk 3% in a book, risk 2%, and you don't risk that money. Someone can tell you that when the 50 and the 20 moving averages cross, you place a trade. You can't just keep seeing it in a book and doing it on a demo account. No, not at all. You have to put yourself in the position the person put themselves in to be able to attain these things. And you can't risk per trade when you're not putting your money on the line. You can't position your trade the right way when you don't put your money on the line. I'm just saying all of this so as to let you guys know, no matter, I say this almost every time, no matter how well you attend my classes, if you're not putting in the work behind the scenes, you're not putting in the work after the webinar, you just attended the webinars, watching the videos regularly, you will never be profitable. You'd have to put in the work. You'd have to do these things the right way. Okay, now what's a lot size? A lot size is just the contract size, the contract you are buying. So let me give you an example. We have three types of lot sizes: standard, mini, and micro. Let's use a general example. There are three cabbage sellers. Okay, there are three cabbage sellers. Okay, seller A buys a truckload of cabbages. Seller B buys a small truckload of cabbages. Seller C buys a bag of cabbages. If they all sell at the rate of $10 per cabbages, who will make the most money? Seller A, right? Followed by seller B, then followed by seller C. That's what lot size is. Now, seller A would make a lot of money. If you use standard lot size, you make a lot of money. Seller B would make money. If you use a mini lot size, you would make a lot of money. Seller C would make money, but not as much as A and B. That's just lot size, and that's how to put it. Now, let's say in seller A has I'm just using an hypothetical example. Seller A, in his truckload, he has 100,000 worth of cabbages. Seller B has 10,000 worth of cabbages. Then seller C has 1,000 worth of cabbage. Those are just like the contracts per lot sizes. I hope you understand. Adeni, I hope you understand. If you do, please let me know. And if you don't, please let me know so I could explain using another example. Great. Okay, great. So we've talked about risks per trade, and we're going to talk about position sizing now. Now, position size. There are two pieces to position size, and they are risk per trade and distance of your stop loss from your entry. Okay. Now, distance of your stop loss from your entry, we should take note of this in percentage terms. Okay. And how do you calculate your position size? Is your total equity, your total trading balance, and the risk you're willing to take divided by the distance of your stop loss from your entry. So let's say my entry is $10, my stop loss is $5. The total distance is what? 5. That will be if I have a $50,000 account and I want to reach 3% of my account, and the stop loss from my entry is 5%. What would the calculation be? Let's do that math on the board. So let me just get a whiteboard. Let's do that math on the board. So let's do the math. Okay, so yeah, let's go. We said there are two pieces. There are two pieces. No, Philip, you're a bit wrong there, but just chill. Let's do the math. Okay. We said there are two pieces to position size, which is risk per trade and distance of your stop loss from your entry in percentage terms. Okay. In percentage terms. Now, we need to understand how to calculate our position size. So how do we calculate our position size? Very simple. I'll give the formula out. The formula is your total equity multiplied X by your what? Your risk. How much you're risking? That's your risk percent divided by the distance of your stop loss from your entry. So let's just do this D for distance and SL less than entry E. Let's just do it this way. Okay. Let's just do it this way. So this is your formula. Total equity multiplied by your risk divided by your distance of stop loss to your entry. Now, I said the example is if a trader has a $50,000 account. So let's take down the parameters. Okay. Equity. Okay. TE as equity. Okay. TE as equity. $50,000. $50,000. And we said the risk R in percentage, R percentage is 3%. And we said the distance from the stop loss to entry is 5%. Let's just do B is 5%. We were told to what? Calculate the position size. Now, if you do understand math properly, you'd know that what we would literally do is just 50,000. There's no need for the comma. 50,000 times 3%. If we convert 3% to decimal, we have 0.03. Okay, 0.03 divided by, okay, let me just divided by 0.05. I'm trying to look for that divide button on my PC, but let's just use this. Okay, 0.5, 0.5. Okay, 0.05. So if we move down, what we have is what? 50,000 multiplied by 0.03. So 50,000 multiplied by 0.03. We have 1,500. Sorry, yeah, 1,500. Oh, sorry, I did divide. 50,000 times 0.03. We have 1,500. Okay, 1,500 divided by 0.05. This will give us a total of what? 30,000. 30,000. So 30,000 is what the position size, that's the total contracts. And now 30,000 in forex, 10,000 is a micro lot. Okay, so 10k is equal to micro lot size. Now, since 10k is equal to micro lot size, 30k will be equal to what? 3 micro lot size. That means my lot size that I'll be using is 0.03. Very simple. Very, very simple. Very, 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 very simple. You'd never get it more easy than this. Do we all understand? Do we all understand? That means the position size I'll be using if I have a $50,000 account is 0.03. Do we all understand? Yes or no? Please drop something in the chat box. If you don't understand, drop a yes, and if you don't, just drop a no. We'll go over it again. Okay, no. Okay. Let's go over it again. Now, we said the formula to calculating positions, you don't need to understand how to calculate the position size. First off, that's just me based on my preference because I don't use a position size calculator. I just understand that if I have $1,000 and above trading account, I'd rather use 0.05 one trading instead of using one standard lot. Okay, so now let's get to it. We said the total equity formula for calculating position size is total equity multiplied by risk percent divided by um, the distance between my stop loss from my my entry. The 30k is my what? It is the number of contracts. Remember, we said a micro lot size is 10,000 contracts. Okay, so the 30,000 now is 3 micro lot size, which is 0.03. Okay, now let's take it from the top. We said the formula is what? We said the formula is total equity times risk. Total equity times risk divided by distance from stop loss to entry. Now, the total equity is $50,000. The risk I'll be taking is 3%, and the distance is 5%. Then what next? I put in all the values. We said 50,000 times 0.03. That's when we convert 3% to decimal. We have 0.03. When we convert 5% to decimal, we have 0.05. So 50,000 multiplied by 0.02 divided by 0.05. We have what? 1,500 divided by 0.05. When we do that, we have 30,000 contracts. Okay? We have 30,000 contracts. And 30,000 contracts, we said, is what? 0.03 micro lot size. Do we understand? Yes, Kelechi, one lot to one pips is $10. That's one standard lot. Do we understand now? Great. Okay. I'd like to get more responses. More responses, actually. Okay. Okay. A few people are catching on. Okay. Great. 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 Now, we understand that how to calculate risk per trade. And risk per trade and position size are quite distinct. Okay. Just note that risk per trade and position size are quite distinct. A trader can trade with a $50,000 account and have a $30,000 position, while they only risk $1,500. That's why I told you guys. I said if I have $1,000 and a move trading account, I still would decide not to use 0.03. Just like I said, it's all based on preference. And for effective trading, just for effective trading, using a good position size is what helps you in determining your standard, your right lot size, your right sort. Like, so it's just for effective trading. If you want to be conservative and all, you should follow this. But if you want to be aggressive, just do what's your preferences, like just based on your preferences. Now, do note that instead of going through all this long math, there are various position size calculators you could use, both online and the ones you could download on your phone. So there's no need for you storing this formula on your head. Okay. So let's move on to the next thing. On to the next thing. Let me just on share this and share the white paper that we're using. Risk management, and here we go. So we've talked about risk per trade and position size. Now, profit maximization, evolving your trades. I know everybody wants to hear about evolving your trades, but what really is evolving your trades? Now, this is one concept I was able to learn after looking at a few traders. Like, I used to see something on social media where a lot of traders will just like open a lot of position and still manage their risk the right way. I'm sure possibly you've seen it before. Like, they open a lot of positions and still manage their risk the right way. And I was able to understand that these people don't just open those positions blindly. They use a concept called the concept of R. Now, the concept of R is using or entering trades at every structure created. Now, let me show you an example. This is very a bit technical, but I believe you understand it. Let me just show you an example. Chrome tab, let's go. Okay, so let me show you an example. Remember we said the market can never go this way. It can never just continue going up like this. Rather, it will go up this way. It will go up this way. Remember I said something like this, that the market can never go up in a straight line, but it will go up this way. Now, the concept of R is that at every retracement, this is a low, this is a high, this is a higher low, this is a higher high, higher low, higher high, higher low, higher high, higher low. Where would they evolve their trade? They will evolve their trade by adding more position at this area right here. At every retracement, they'll add more positions, add more positions, add more positions, add more positions. That is how they evolve their trade. Now, how do they apply this method? They only apply this method when their trade is in profit. Now, they have entered a trade where they are in profit. That is why they are adding more position. If they are in a loss, they will never use the evolving your trade method. Okay? They will never use this evolving your trade method. The same applies to if price is trading in a downtrend. If they enter a trade here, it goes down, it retraces, they add more trade. Remember, the more they add, the more price goes down, this one position here is in maximum profit. So they are not risking risking anything on these new trades. What they are risking is just the profit from this first entry. Do we all understand? Do we all understand? That's just the concept behind profit maximization involving your trades. That's the simple concept behind profit maximization involving your trade. So, how do you understand or how do you learn this method? It is when you dedicate time to the charts. You can't just go to the charts and start adding position at every retracement. That retracement could be a reversal. You need to just understand how that one currency you want to major into behaves so that you don't get caught on the wrong side. Exactly. Like it's like compound interest. But this is just if you don't call it involving your trade or profit maximization, you could call it scaling in, like you're scaling in more positions to get the max out of that one trade. Let me show you an example. An example is what I did on CAD right here. An example is what I did on CAD. Let me just reset this. And okay, let me just turn this chart to the right way it is and see right here. Sorry. We had the first move to the upside. The retracements are entered here. So that's what evolving R just means. Like that's what evolving R is. Simply put it as evolving R. That's what it simply means. Adding more positions at every retracement, scaling in. That's what it means. Do we all understand? Do we all understand? Yes or no? Do we all understand? Let's do what to drop something in the chat box. Do we all understand? Okay, now handling drawdowns. Handling drawdowns. Handling drawdowns. Now, not everybody is able to handle drawdown, but to be candid, to be very, very candid, you just need to accept the fact that, or you need to accept the idea that the market will at some point hand your ass to you. It will at some times just hand your ass to you, like hand it back to you. And that is the only certainty in trading. That is the only certainty. That's one thing I can guarantee you of. Like there is a point in time, no matter how well your trades are on point now, the market will suddenly just like take your ass back, like take it back, just hand it back to you. And in this fact, this is where the right risk management comes in. If a trade manage, if you are a trader, okay, and you manage your risk well, no matter how much the market slaps or beats you up, you will surely still be in the game and on the positive side because you are managed or you've managed your risk the right way. No matter how the market beats you, slaps you, hands your ass back to you, and you manage your trade the right way, you'll always be on the top side. Now, drawdowns actually affect us psychologically. Psychologically, that's how drawdown affects us. If it affects us psychologically, and when you continue having a drawdown, not even on a trade, on your account, I'm talking about your trading account in general, not on a trade. Drawdowns on a trade are general. We could enter a trade, think it's sniper, and it goes into loss for a while before moving in our direction. We could undo that. But drawdown on your own trading account, it is mostly psychological, and it is difficult to deal with when we continue seeing losses. When we continue seeing, it's very difficult to deal with. But the best way to handle a drawdown is to just stand up from your trading index, take a break, and just go out and do something else. Yes, do some. That's the best way to put it. Just go out and do something else. Because if you continue sitting on that desk, continue trading, you end up losing more money because you'll be trading with aggressiveness and greed. You'll be trying to risk more to make everything you've lost back, and in that sense, you could lose more. That's just the whole structure behind it. And when you have a drawdown, how do you mitigate your drawdown? Now, mitigating your drawdown means how do you recover from your drawdown? This is a simple checklist you can use. Can your win rate take a losing streak of 5 times? Now, we talked about risk to reward ratio. If you have a risk to reward ratio of 1:3, you are risking 1 to get 3. It is fine. Can you handle a drawdown 5 times? Yes. But can your accuracy in the market take that drawdowns 5 times? The answer is no, because of you're trading based on luck. If you're somebody that is trading based on luck, then your answer is no, because you're only doing you're just throwing a dice in the market and you're expecting to get 6 every time. It's not possible. So you need to understand your win rate. That means if you place 10 trades, can you win 5 out of that 10 consistently? Can you win 6 out of that 10 consistently? That is what your win rate is all about. That's the first thing you need to ask yourself. The second thing you need to ask yourself is, did you have a good trading rule? Are you following your trading rule? Or do you have some sort of system that helps you trade? And are you following the rule? That's the question. Then the second thing is, have you been following that rule, that system? Have you been following it? The third thing is, what links you to those losing trades? Why did you lose those trades? The next thing to ask yourself is, do you need a break from trading? There are times you need a break from trading, but you just don't know it. You need a break when you make a lot of profits. You need a break when you make a lot of losses. Ask yourself, do you need a break? Then the last thing is, have you considered reducing your risk? Those are the questions you should ask yourself, and those are the questions that needs to be in your checklist. Then the last thing when it comes to handling drawdown, survive. Once you can survive every single phase of drawdowns, you could survive anything else the market throws at you. That's why it's last thing. Focus on survival. Just to survive the market, survive that phase of drawdown, so you could see light at the end of the tunnel, which is so you could make profits in the end. Now, Randy McKay said something. He said, whenever he gets hot in the market, he gets the hell out. It doesn't matter to him whether the market is trading higher or lower. He just gets out of the market, because he believes that once you are hot by the maker, your decisions are going to be less subjective than they have been when you are doing well. If you continue to stick around when the market is severely against you, sooner or later they will carry you out. Like, it's very, very funny. Like, if he has a loss, he leaves the market immediately. And if you decide you are a pro and you want to continue staying there when the market is beating you up, slapping your face and all, they will carry you out in the end. Like, they will have to fund you back. Like, you have to beg for somebody to fund you back. So the thing is to get out whenever you're taking a beating from the market. Just get out. Don't say, I believe it will reverse. I believe it will. What if it doesn't reverse? I believe it will go my direction. I believe it will. What if it doesn't go your direction? That's the question. And I hope you do understand everything we talked about when it comes to handling drawdowns. Now, using margin the right way. Using margin the right way. Do we understand everything we talked about when it comes to handling drawdowns? Please let me know if you do. Please let me know if you do understand everything we talked about when it comes to handling drawdowns. I'd like to get more responses. Thank you. And also, if you've got any question, you ask your question. Don't worry, I always set out time at the end of our webinars to ask questions. Okay. Yes, drawdowns are just losses. A period of time in the market where you are in deep loss. That's what drawdown means. Okay, since everybody understands, let's go to using margin the right way. Now, what is margin? Margin is relatively the same as leverage, and it just means borrowed capital from us, your broker, to open a position bigger than the one available to you. Now, the concept of margin is if you have a $10 account, you could trade $1,000 on that $10 account. You could trade $1,000 worth of contract on that $10 account. How do we do it? We give you margin. Now, our margin is 1:200. Okay, 1:200. The one there is the amount you have. So let's say you have $10. The ratio 200 is what we want to offer you. We want to offer you 200 of your $10. We want to offer you 200 multiples of your $10. That will be what? That means we're offering you $2,000 to trade, although your $10 will be there. Now, what do we do when we offer you $2,000 to trade? It means every single time you place a trade, we just take a part of your $10 and we give you a part of that $2,000. That's what margin is all about. Now, how do you use margin the right way? Okay, Philip said, does handling drawdown part of risk? Yes, you need to understand how to handle drawdown unless you use it all, and that's how you manage risk. Now, with margin trading, whenever you're trading with margin, you could get liquidated anytime if you're doing the wrong thing in the market. Note, if you're doing the wrong thing in the market, you could get liquidated anytime when you're trading with margin. Liquidation can come anytime when you're trading with margin. And that's what you should avoid. That means you must understand the reason you are giving margin, which is to place appropriate trades. That is why I always say for you to know how much you'll be risking per trade and the position you are sizing. That's just the major thing. And to be candid, margin trading is very risky and it can accelerate your losses. Now, there are other brokers out there that give you leverage or margin as much as 1:2,000. I even had one broker gives an unlimited leverage. I was like, wow, people just lose money and they don't know they're losing money. Why do we give you a 1:200 margin? We don't want you to shoot yourself in the leg. That's simply what it is. We don't want you to shoot yourself in the leg. That is why we give you a 1:200 margin, so you can manage your risk appropriately. That's why we give you a good or a limited amount of margin. And how do you use margin the right way? That's when you know how much you'll be risking per trade and how you position yourself in the market. That's how you use margin the right way. And also, don't try as much as possible when you're trading. Don't try as much as possible to use all the margin at once. Okay, just to leave some behind so that you could be able to leverage on it even if you are in a drawdown. And that's just the major thing behind it. No, margin trading is not the same as options trading. Adini. Okay, margin trading is not the same as options trading. If you're talking about crypto, margin trading is not the same as options trading. When it comes to crypto, margin trading is the same as futures trading in crypto. Okay, in crypto, in quotes. Now, that is just everything risk management entails in 1 hour 28 minutes. This is everything risk management entails in 1 hour 28 minutes. Now, the conclusion. Now, I always try as much as possible to clear the air whenever I talk about conclusions. And here is the conclusion. The first thing I would say, concluding this webinar, is I can never, okay, and I cannot stress enough the importance of risk management. See, I don't know how to say it multiple times, but if I continue telling you the importance of risk management, I'll look like a bad person. So you have to discover the importance of risk management yourself. That's why I cannot stress enough the importance of risk management. Just know that risk management is crucial. It is important. It is the backbone of any good trading strategy. And that is what separates you as a trader from other people that are gamblers that call themselves traders. The next thing is to focus on survival. When you focus on surviving the financial market, you can survive anything in the world. I'll be candid with you. Manage risk the right way. It will set you up for greater pastures and greener pastures when it comes to the financial markets. One of the best things you can do for risk management is keeping a trading journal, a track record of trades you take. A track record of trades you take. a track record of trades you get. That is what trading journal is all about. By building a trading journal, you can look back and see the best risk management that has worked for you, which setups you trade that are the best, and what links your best trade and worst trade, and a lot of things actually. Like I said, this is just a basic lesson on risk management. Every single area of risk management I've talked about, they warrant further and continuous study. Then lastly, know that you are trading in leveraged markets and you must exercise the utmost caution when trading. Hone the concept of applying the right risk management, and that is how you excel in the financial market, and that's how you survive the financial market. Thank you all for attending this webinar. Okay, so has anybody got any questions? Let's start from with questions. Let's start with questions. So Kelechi says he's been expecting the package on order block. I can't even find the PDF. That's the thing. If I found the PDF, I would have sent it to you, but I really can't find the PDF. I think it's on my drive, one of those my old drives, and I'd have to look for it. That's why. Now Adini says, how do you take some of your $10 equivalent? Do you say 500 and keep the balance for another? Yes, that's how we do it. We just give you a part of it and we'll keep the balance for another trade, so you can be able to use it to borrow more. That's just the concept. Don't mind me saying borrow, but that's literally what it is. So it's like we're just keeping that aside, so that we know, okay, we have a collateral because of you've borrowed from us. We just keep it aside as collateral that, okay, you've borrowed from us, we've kept this aside from your balance. So I'm still expecting questions. Let's just spend 8 more minutes on the call expecting questions and all. So to post, let me just add one more poll or two more. So I just sent in a poll. Please let's do what to respond to it. Thank you. Thank you very much, Udo. Thank you for joining. It meant a lot to me. Soya, thank you very much. It means a lot to me, actually. Okay, no problem at all. I just use it for entries, majorly entries. I'll do, once I find it, I'll do what to share it. We've got nothing to worry about. So please, let's do what to respond to those polls. No, we are keeping a balance out of your $10. We're keeping a balance out of your $10. So we could decide to keep a balance of let's say $3 out of your $10. There's a way it works behind. It's very, very complex though, but there's a way it works, and it might be too complex to explain at all. You don't have to fund any new $10. Okay, you don't have to fund any new $10. How can you mitigate drawdowns in a bearish and a bullish market? Okay, how can you mitigate drawdown? Just instead of holding the trade, why don't you just close the trade and take a step back and understand why you had that drawdown? That's the major question, or that's the major thing. Just close the trade. Closing the trade means you've mitigated the loss, and you take a step back and think through, why did this happen? Why did this not happen? And you ask yourself the right questions. Joy, is this your first time attending my webinar? Please let me know. Is this your first time attending my webinar? Okay, I asked the question earlier, though. I think you were not on the call. So Joy, this is your first time attending my webinar. I would love to reach out to you after this webinar. Okay, if this is your first time attending the webinar and you're still on the call, please just let me know. Let me know, okay? So I dropped the poll. We are 16, we are 15 on the call. I'd love for everybody to reply to the poll. Okay, just it takes a few seconds actually. So I just sent in another poll right now. So please let's do all to respond. With 15, we could do better than just 5 or 10 persons responding to the poll. No, Joy, I won't be calling you. I'll just send you my number and just send me a message on WhatsApp. Yes, just all you do is just send. I'll drop my number right now. So just send me a message on WhatsApp. I'll just drop my number right now and just send me a message on WhatsApp. Okay. So just EGM financial analyst. There you go. Sent it in the chat box already. Okay, if you're the one that said yes, you'll be funding your trading account right after the webinar, do send me a message on WhatsApp. My number is on it's on the chat box or in the chat box actually. I've got something for you. Okay, I've got something for you. Okay, if you're the person, 2 persons, okay. If you're that person, just send me a message in the chat on my WhatsApp. I've got something for you. Okay, so yeah, great. We've got 3 more minutes to spend on the webinar. Please let's do what to respond to the polls. No poll is small to respond to. Okay, and that's the only way you can pay me back for my time. Okay, 1 hour 36 minutes on the call, and that's the only way you can pay me back for the 1 hour 36 minutes by just responding to the polls, giving me a feedback on the polls. That's just it. Okay, thank you very much. Thank you very much. Okay, so has anybody got questions? I'm still on the call. Waiting for questions. The 3 persons that said they'll be funding their trading account after the webinar, I've got something for you. All you need to do is just send me a message on WhatsApp. Thank you. Just send me a message on WhatsApp. We've just got 2 minutes left to be on the webinar. Okay. So thank you very much for joining the webinar. I hope to see you in the next webinar. We have another webinar on Thursday. So I hope to see everybody in the webinar. Okay, Joy, no problems at all. I hope to see everybody in the webinar. Um, yeah, till Thursday. You could reach out to me anytime at all. Anytime at all on WhatsApp, and I will do what to give you the best and the most appropriate response. Thank you once again, and see you on Thursday.